Felipe, please.
Yes, thank you, Julio. I think this is a very interesting topic, but I will refer mainly to the first part, to the negative interest rates. And I would like to pose a question to both of the speakers, but probably this belongs more to the central bank realm. What are the effects of negative interest rates? Have they been monitored in terms of the real estate effects? Are we kind of promoting a real estate bubble with negative interest rates? It was touched a bit, but I think this is creating a big problem for pensions. Because getting returns for pension managers is becoming more difficult and at the time, and if you put this together with pay-as-you-go systems, with fixed retirement ages, and a fixed retirement age, and increased life expectancy, very low returns, it either creates very low pensions or a fiscal problem in the future, or a combination of both. So I'd like to hear what you think. One aspect that was briefly touched was the role of insurance companies. I would point to the fact that insurance companies are in a very delicate situation right now, because when someone hires a life insurance, an annuity, you have to cover your liability with assets of comparable length that provide a decent return. Otherwise, what are you going to offer in terms of pensions? Are we creating right now in many countries, life expectancies are being reassessed. So you get an annuity and you get a lot of instruments with negative rates. So I think that's another issue. The final point I'd like to make is about the permanence of these negative interest rates. One major issue, and this was touched by Mr. Gonzalez in the second presentation, one major issue is that we are in a world of very low growth. With very low growth, as a golden rule, we know that will lead to very low real rates, but not negative rates. As an equilibrium, sort of a longer-term equilibrium. Of course, then you have these as short-term rates and then the long-term rates. But you see that already in Switzerland, you mentioned that the 30-year rate is negative. So what are we pricing in terms of growth and maybe in terms of inflation? Are we pricing in some kind of deflation? Is that a real danger right now? Let me stop there. Thank you.
I enjoyed the presentations, but there is a certain risk that we are taking for granted that the negative interest rates will have forever. So this introduces a new type of risk of a peso problem that for sure one day will experience a higher interest rate. And we never experienced in the past exit from what both presentations are outlining as a long-run living pattern with low and negative interest rates to a new environment which will be closer to the old normal. Now, we cannot focus when it will happen, but the risk is that maybe some policymakers will be afraid of this exit and they will propagate policies that may continue it. In this context, let us keep in mind that even negative real interest rates are not identical to negative nominal interest rates. So it's really the combination of inflation targeting at low rates and the huge increase in saving that induce us to be stuck in this way. Now, I doubt the ability of emerging markets to follow all the innovations of the Bank of Denmark. And the risk for emerging markets is that the compression of the de facto risk premia may backfire more in emerging markets than in Denmark and more advanced countries. So the bottom line, I think that it's quite easy to be tempted that we can live for the intermediate long run with negative rates, overlooking the growing exposure to a peso type of a problem, that will penalize, I believe, much more emerging markets down the road, implying also that emerging markets may consider that not necessarily they should follow the latest innovations in Denmark.
Pablo?
Thank you. I have a question and a comment. The question is on the argued in of negative nominal interest rates. My sense is that the costs or the ineffectiveness is due to the fact that central banks or policymakers in general are not allowing the full effect of negative interest rate to play through the economy. We used to see a problem that we had the zero lower bound. Now we've reached that zero lower bound. That should be good news. And I believe that we are seeing it as a problem because on the one hand, central banks that are implementing negative interest rates in the short end are also implementing QE-style expansion of the balance sheets, and therefore they are flattening the yield curve, and through that they are preventing the credit channel from operating because one would assume that the benefit of a negative interest rate through the credit channel is for banks to increase lending, but if the central bank is a competitor in that part of the credit market, then that part of the channel is broken. And the second policy decision that is not allowing negative interest rates to work through is, again, because of political reasons, not to allow deposit rates to go down and become negative, and therefore putting the whole weight of the transmission mechanism on the exchange rate. And that makes for a very lopsided adjustment to this negative interest rate policy. So isn't it the case that the costs are because we are not allowing negative interest rates to play their actual role to be more expansionary? And the second, on a comment on these new technologies and blockchain and such, on the future of money and central banking, I think that you still will need standards. Today, for instance, 2/3 of the farming of Bitcoin is made in China by farmers that are hooked up to hydropower plants. And the community of miners has split between different standards. That shows that still you will need some regulation and supervision of this technology, and therefore some role for regulators and central banks. What it means for banks, maybe this is a different question, but for central banks, I think that would be still a very important role. Thank you.
Please. Please, the last one, and then please, sorry.
Okay. My first comment was, similar to Pablo's. We need to understand much better the non-linearity of the transmission mechanism to low real rates and negative rates. Where are we facing policy issues that are generating this non-linearity, and where it's basically behavioral issues that we cannot fix through policy? I think the second observation, looking at Manuel's presentation, is that, given the legacy of the crisis, given the still important challenges that Europe faces, and given the technological uncertainties that the banking industry is facing in the next decade or 2 decades, it's hard not to ask why is bank restructuring taking so long to happen in Europe. Looking at the Latin American experience after our crisis, the banking system in Latin America was completely transformed, and we're not seeing the restructuring that needs to take place in Europe, basically to reestablish a bank lending channel that works, and to reestablish a functional financial system. And my last question regarding technology is that on the other hand, technology is also presenting, I think, a significant informational advantage to banks, especially in less developed markets, where the substitution of the consumer to these new means of intermediation is much lower. On the other hand, the new technology is providing banks a huge informational advantage vis-a-vis consumers. So now banks know much more about their clients than what they knew before, so they can price products much better. They can significantly extract the consumer surplus through pricing, through the offer of new products. So, this trade-off between the enhancement of the market power of established banks vis-a-vis the competitiveness nature of these new innovations, how it's playing out in different markets. Maybe we saw in your presentation a view that it's too much of an advanced market nature, and maybe it's playing in a different way in less developed markets.
Thank you. I think sort of behind most of the comments lie sort of a risk in the present policies, in the sense that central banks keep interest rates very low, are using unconventional measures in order to stimulate the business cycle. Of course, there are trade-offs. What will that do to financial stability? What will it do to the housing market? What will it do to savings, insurance companies? Apparently, this trade-off at the moment is still assessed in a way that it's better to keep interest rates very, very low, but the risks are there. And I'm concerned about the risks as well. I think, does it encourage house price bubble? We look at the Danish case, I would say the very low interest rates, the answer is quite clear. Yes, we see very strong increases in house prices, especially in the big cities. The relationship towards the pension sector, I think there are many links. We have seen in many years a tendency for defined benefit systems to disappear to defined contributions. We also have seen a movement away from annuities towards pensions that only pay out for 10 years, 15 years. That's because the insurance companies have difficulties in writing the contracts with the increase in the age of the population. We also see, and that's part of the low interest rate environment, that some life insurance companies are now going into the lending business. So that there's a fierce competition with the banks in the lending business. The insurance companies are doing because interest rates are very low. They need higher returns. And some banks have started to complain that the capital requirements on lending business in the insurance industry is not the same as capital requirements on lending business in the banking industry. And then I'm also very concerned about the exit from this policy. I think some of the questions are concerning the exit. I mean, citizens, households, companies have now experienced declining rates for 20 years. I mean, even 4 years ago we said rates can't go that much further down. What happens if you're used to interest rate only loans at zero interest rates when you have your mortgage, and then suddenly you face an increase? What will be the reaction? I think we are a bit in uncharted waters after 20 years of declining interest rates. So that would be, would that transition be smooth? That's I don't know. As regards innovation technology, I'm also convinced that we are some way away from the cashless society, and I still think there will be room for authorities, and I think it's also important to create a level playing field. But I also see what we're seeing nowadays is probably what we, from a competition point of view, has been looking for many years. Now we probably see the handles in the marketplace to sort of commoditize the banking industry. Quite a lot of industries have been commoditized over the years. Now the handles are there in one way how to do that. So that should benefit consumers and businesses. And then I still think that the core business of sort of credit assessment is still somewhere in there. That will probably stay there. And I think the banks could, I mean, there are at the core of the system. If they behave properly and know what to do, they still have an advantage. But I think the window is closing. And then I think central banks will probably be around for many years, but I think it's worth challenging. If things are growing exponentially, as someone said, then the exponential growth is quite interesting compared to the linear thing. So who knows? Thank you.
Thank you very much. José Manuel?
I would agree with to what the governor said on real estate. Pension funds and insurance companies indeed are going to a very rough spot. and some are facing difficulties coming from low rates, but also from issues outside, which are life expectancies and so on. So possibly the next financial crisis will not come from the banks, we will see, because they are huge in size, especially in Europe. But as regards the permanence of very low rates, I mean, if one believes what the main studies that one could look at these days, this morning I was going through a conference of John Williams, the Fed president. We have to expect low rates for very long. And low rates meaning closer to 0 than to 1 in the case of the US. This, of course, could create risks of deflation, and this is why possibly central banks would have to remain in a non-conventional mode for many years, just to signal that they would not be for lack of funding and liquidity, that demand cannot be created. So this is why I mentioned in my presentation the fact that maybe these unconventional policies, including negative rates, might become a standard instrument going forward, which is not very satisfactory and not comforting, especially from the point of view of governors of central banks, if only because, and then I link with the question made by Professor Eisenman, isn't it true that the authorities could fall in a trap, which is the low rate trap? You provide low rates, the economy learns to function with very low rates, including institutions, forget about pricing in the markets, and this makes the financial system more vulnerable, more feeble, so that central banks are fearful to raise rates at some point for fear of rocking the boat. So there you are trapped in a low interest environment, possibly creating problems at the expense of trying to avoid different problems. And this is quite an issue, has been highlighted a long time ago, the low interest trap. I think that the best way out is to talk as clear as you can about the conditions under which you would exit this very unconventional mode. And I note that this is a very difficult task when you are listened by the markets after all press conferences. But if you instill the expectation that at some point there will be an exit, I think agents would try as much as possible not to forget that there is some pricing and some price discovery activities that they have to embark on in normal times, whenever those normal times come. And this is the difficulty. You cannot call exit today when the exit is more likely to be in 5 years than in 2 years. That's a great difficulty, I think. You're right, Pablo, that of course there are things that stand in the way of these unconventional policies to be fully effective, including those you mentioned, that QE is competing with the banks. But I would say this competition is healthy to the extent that if the government or the markets are buying corporate bonds, this goes into funding investment, which is what we want. So it is not defending the banks. The banks have a competitor, and for a good reason. I think QE is fully justified. So if there is no bank lending, but there is lending by markets or governments buying paper, so be it. I think it's good for the economy, and in that sense the policy would be effective. With respect to deposit rates, there are many countries where there are no legal impediments to go negative as you wish, but there are de facto impediments linked with competition to preserve market shares, linked with the attitudes of savers that would take the money out and put them in investment funds and money market funds. So there are de facto constraints to see the full impact that we would expect here, not just legal or created by the government. Of course, digital needs standards. I would not link very much digital to Bitcoin. Bitcoin is an anecdote here, and not a happy anecdote, I would say. It is the technology underlying Bitcoin which is really disruptive. This way to decentralize, in a decentralized way, checking identity, producing transactions with very low cost, almost instantaneously. Of course, you have to distinguish permissioned blockchains, which are those where, like clubs, you know who is the member, so there is an issue of identity that you can sort out, and also the bad guys may be left outside. Of course, there is always a bad guy coming in, but the risk is less. And the government, the supervisor can be a node in the blockchain, which is very good because they would have access to all the information they need in real time about the transactions they need to supervise. Of course, there are many, many obstacles yet. You need a homogeneous legislation in order to implement smart contracts, which is the underlying legal, I would say, infrastructure that you need for these contracts to function. You cannot stop the blockchain every time there is a legal dispute. So you need clarity in law, smart contracts, a single legislation, and a procedure to put aside some transactions where you detect something strange or wrong. And finally, I fully agree that there are technical advantages in incumbents, with incumbents, if they understand what is the main value that they have still and they have to preserve, which is the knowledge of the client. So if you know your clients and you understand that the client is at the center, more powerful than ever because they have this thing, and with this thing they can compare, they can move instantaneously, then there are great advantages both in developing countries and in developed countries. In the case of developing countries, maybe advantages are more precisely because the pressure of new challenges tends to be less. And also reputational losses associated to the crisis are less because the crisis was mainly linked to the US and Europe, but not to other parts of the world, so there is not such a loss in reputation and confidence. So in that sense, there is an advantage also because you can skip many stages in financial development, jumping straight into the digital world if you are able, and this is mostly for the governments, you're able to develop the digital infrastructure you need, bandwidth and all those things, access to internet and usage of the internet.
Well, thank you very much. We are a little late, but we have 15 minutes coffee break, please. Thank you.